Good evening, everyone. Would you like to make your way to your seats if you aren't there already? I'm going to kick us off. A warm welcome to those online tonight as well. And thank you for coming out. It was, I don't know if you guys heard the thunder in the middle of the night, but it was lovely to hear thunder and have some rain lying in bed last night. So hopefully the rains are on the way. We desperately need them. So that'll be good. So a warm welcome this evening. So a number of weeks ago, I wrote an article in Intuition. I'm not going to ask who read it, on this topic of deconstructing risk. And I thought I would just expand on it a little bit more tonight. And it's really about breaking out of industry paradigms. And Harvard House always says that we are completely different in our approach to the market. And so I'm going to illustrate how we see risk differently and why we see risk differently. And then we're going to explore it and take it in. Now, everyone's asked me so far, am I going to come with good news about the market? I'm not talking about the market tonight, but it is good news. You should have all had your portfolio statements and seen that they were nicely up at the end of last month. So hopefully that is good news from there. But let me jump right in. So anybody like to give a guess or an educated idea of what that is? And don't go with a clever guy in Joburg who said a random set of numbers. Okay, so Jimmy is pretty close. He says, are those what the different shares have done? Well, actually, that is a sequential annual return on the JSE going back to 1960. So if you're an avid reader of Intuition, you would have seen in the January edition that chart. And what that chart does is it says, it takes every year, so every one of those blocks with a number inside, that's the year. It goes all the way back to 1960. And it plots what happened in that particular year. So each zone here, so this is 0 to 10% in the year, 10 to 20, all the way up. And here's the one we're all waiting for. We want a repeat of 1979. I was 10 years old. I reached double digits in that year. So I'm turning 55. I could cash in my RA and become a pensioner this year. And it would be a really nice present if we could have a 90 to 100% on the market. But I don't think I'm going to get that. So we see 2018, that was kind of when the woes really started in South Africa. And you can see it goes back to my birth year. 1969 was also in that phase. And then we've really had this litany of market returns sub 10%. 21 gave us double figures, but that was a recovery from COVID. So maybe just a bit of an anomaly from that point of view. Now, I am trained in statistics. I studied in statistics. That was my major at university. And so tonight I'm going to make you quasi-statisticians. And when you leave, you'll get a certificate saying that you've attended my course and that you are a quasi-statistician. What we would normally do with this kind of data is we would draw what we call a normal distribution. And that's really what a normal distribution looks like. And you can see it sort of follows the basic trend. So I thought what we had to do is we really had to pull our presentations into the new age. So I turned to ChatGPT. Does everybody know what ChatGPT is? AI, the thing that's maybe driving markets. And I said to ChatGPT, I gave it this data, and I said to it, please won't you draw me a normal distribution? And I even told it to make the blocks the Harvard House color. So ChatGPT returned that. So that is a normal distribution. Now you can see I asked it to include the mean, which is the dotted line in the middle. And, you know, when you're a scientist, you want to talk in a way that the average man in the street doesn't understand you. So you can't use terms that he would use. You've got to use something else. So that dotted line is the mean, which for all you public Joes is the average. Okay, that's all that means. And then you get the dark green line, which is the median. Now, the median is just the exact middle of the data sample. Okay, and when the mean and the median are very close to each other, then you know that the distribution is actually quite evenly spread around the mean. And then you get these two blue lines, dotted lines. And those are known as the standard deviation. Now, the standard deviation is calculated so that one standard deviation either side of the mean or average covers 65% of all the data points. And what the general industry wants to do, and it reports it on all its funds, is to keep the standard deviation as close to the mean as possible. So the industry wants those blue lines not to be too far out. And so we can see here, if I look at the annual returns of the JSE going back to 1960, the average return was 19.23%. Now, given the last 7 years, you probably don't believe that. And the standard deviation is either plus 23% or minus 23% either side of that 19%. And that's kind of the range of 65% of the time, the annual return on the JSE. So that is how the industry generally measures risk, standard deviation around the mean. Now, what we want to do is we want to say, gee, can't we get a better return with lower risk? So the idea is we'll go and add some bonds in, because bonds still grow, but they are less risky. So what I did was I went back to ChatGPT. I gave them all the bond data going back to 1960, and I asked it to do the normal distribution for me. Interestingly, after this morning's exercise or presentation, I had a client come over to me and said, why did you ask ChatGPT to do that and didn't do it on the spreadsheet? And I said, because that took about 30 seconds and the spreadsheet would have taken me 4 hours. That's the simple answer. So there's the normal distribution for bond returns. Okay, we've got all the same characteristics. So you can see the mean and the median quite close to each other, with the mean or the average at 9.4%. And the standard deviation, 11% on either side. So you can see it's a much narrower range of data between bonds and equities, which is why the industry says, well, I need to manage risk, so I want to introduce some bonds to minimize that. Now, sometimes that can be, I mean, that's quite exciting for statisticians. And, you know, in my family, I kind of went through this life thinking that most of us were good at numbers. And then there were a very small set of people, like ballet teachers and art teachers, who couldn't do numbers. My daughter's an art teacher, by the way. And then I had a family. And I realized that actually the unusual people are the people who can do numbers. And the far bigger number is the people who can't do numbers. I know that because I'm laughed at my family. They call me the spreadsheet man. And they think I'm mad. Dad, go and build a spreadsheet for that. So I know that if I put this in front of my family, they would be yawning by now. Going, Dad, we know you're excited, but this is very boring. So I thought, well, how can I show you this in a slightly different way? So there's another thing in statistics called Bollinger Bands, okay? And what we can do with Bollinger Bands is really show it to you a little bit more dynamically. So in this case, this is the JSE, and I've taken the really, really tough last 7 years. The black line is the actual price of the JSE All Share Index. And that's a moving average of 30 days. That smooths it out. It's not every day's point, but it smooths it out. And then the Bollinger Bands are 2 standard deviations either side. And that 2 standard deviations covers 95% of all the data points. So you can get the idea that the smooth averaged is the dark black line, and then on a day-to-day, there's a range between the shaded gray. And you can get an idea of what volatility is like as we go through the market. Now that's the equity index. There's the bond index. And immediately you notice that that line is a lot less jagged. It's much smoother. And the gray shading, it still exists, but it's not nearly as wide. Okay. And so here we've got the 2 asset classes. And so ultimately what it leads to is that the industry becomes alchemists. So most asset managers have a pet owl, and they have a crystal ball on their desk, and they have a pot like that, and they stir in the equities and bonds. Not really. But actually, I've met some of these guys, and they are a bit like mad scientists, so you never really know. But that's really what happens. So the industry as a whole is trying to blend between these asset classes, and they're trying to minimize the risk. And the holy grail, or the alchemist dream, is to have equity-like returns with bond-like risk. That's what they're really trying to do. And so everything they report will be focused on risk. We've given you this at this risk. So much so that you can win industry awards. You might not be the best performer, but you produce the best return relative to the risk you took. How do I know that? We've won a few of them. And so we understand that risk, this whole idea of risk, is where the industry sits. But there's a problem with it, because everything that you try and do in this space comes at a cost. So let's have a look at that. I've taken exactly the same data, and what I've done here is I've plotted it in 20-year periods. So if I go to the first data point, which is 1979, that point of 18.4 is the 20-year return from 1960 to 1979. If I'd been purely in the JSE All Share Index, I would have got 18.4% annualized return over that period. And each data point going along there is exactly the same. And we can see as inflation came down structurally, returns have also come down in line with that. The second line, the light blue or gray line, is the typical balanced fund approach. This idea of add some bonds to bring the risk down. And so what I've done there is I've used 60% in equity, 30% in bonds, 10% in cash. And if you go and look at all the major balanced funds, that's round about the mix that they will go with in terms of those asset classes to try and give a return, but reduce the risk. And so you can see, I automatically, and it's visible there, I get a lower return in order to eliminate that risk. At the biggest margin, which was ending round about 1987, my 20-year period would have given me 23.3% in the equity market, but in the balanced fund, 16.9%. So that's close to 7% difference between the two. And then if I look at the period sort of round about 2004, 2003, 2004, my closest differential was 18.5% in the equity market and 17.2% in the balanced fund. I think that once we start to get the 20-year period ending now, we could see those come closer together as well. But I know, again, because you don't like numbers, most of you, that it's far easier to see it if you bring it back to a real world example. So what I'm going to do is I'm going to take the best and the worst, and I'm going to assume that I invested 500,000 Rand at the beginning in each of those, and I'm going to compare the two. Now, I am painfully aware that if in 1960 you had 500,000 Rand, man, you were loaded. Absolutely loaded. What you probably paid 20,000 Rand for a house back then, even less maybe. So 500,000 is a lot. But a 500,000 investment there over the next 20 years, if I'd been pure equity, I would have had 16.4 million. And if I'd been balanced, I would have been 7.6 million. That is the opportunity cost of getting away from risk. What about really close? Well, if I put 500,000 over 20 years, I would have had 10 million in equity and 8.8 million in the balanced. Risk, avoiding risk costs you on the upside. And it's visible no matter where you go from that point of view. And you see, the problem is that we really hate, I know, because you've told me, you hate getting that statement where my value does this every month. Can't you just make it do this? You know, we have people who come in and they show us the statement and I go, my investment's doing really well. We'll go to page 4 and we'll see they're in the money market. Haven't beaten inflation over any period of time, but they're really happy because the graph just looks like this. But they're not making any money against inflation over time. So let's look at the law of unintended consequences. So the law of unintended consequences refers to outcomes that are not the ones foreseen or intended by purposeful action. This concept is often discussed in economics and social sciences, highlighting how actions, especially those taken by governments or large organizations, can lead to unexpected results. There are 3 main types of unintended consequences. The first one is unexpected benefits, positive outcomes that were not anticipated. Unexpected drawbacks, negative outcomes that occur in addition to the desired effect. And then the one we're going to look at tonight, the perverse results, outcomes that are contrary to what was originally intended, often making the problem worse. Now, in the investment industry, millions is spent on telling you that they're better than the guy next door. They've given better returns than the guy next door. And that's where it's spent. Now, I don't know if you know this, but over the last 10 years, if we add up every single person who died as a result of an aeroplane crash, that number wouldn't see 50,000. But the World Health Organization tells us that almost 1.2 million people in car accidents. And what is the reason for that? Well, do you know that the airline industry, the airplane industry, has an agreement never to compete with each other on the basis of their safety record? And every airline company shares in real time the data from everything that goes wrong with each other. And yet, in the motor vehicle industry, they compete against each other on the basis of risk. And so this is one of the unintended consequences. The airline industry has become one of the safest industries in the world from a human perspective because they keep working on the problems in real time, but the motor vehicle industry doesn't because they're competing with each other. And so we have an industry that is telling you that the most important thing is what your return is. So the perverse results of focusing on investment return and market risk as a competitive differentiator is that in the public's minds, the only important factor in investment is return. If my financial plan is not working, it's the asset manager's fault. Can't he go and get Trump to keep quiet? Or those Russians not to send missiles to the Ukraine? Then becomes the next thing is the most important thing is to reduce the risk per unit of return. Now, I'm pretty convinced that in the future, we are going to see some young people today suing their pension funds for the trustees allowing them to be too conservatively invested when they were young, because they're not going to achieve their goals when they're old. We regularly see young people being far too conservative in their investment outlook and not taking enough risk, because I'm a conservative investor, and that's what the industry tells me I must do. So what happens is there's a lack of emphasis on other behaviors or conditions that impact outcomes. That is left to the financial advisory industry to try and impress on their investors. And the advertising spend of the financial advisory industry is a fraction of what the asset management industry is. And so that noise gets really, really drowned out. It's getting better, but largely it's been drowned out. So let's look at this a little bit more. We think that these are three risks that are much more important. And if we deal with them, we believe if they're managed well, then market risk is hardly a concern at all. The first one is longevity. We're all living older. I said this morning that when I was a kid, if someone turned 80, man, that was a party of note. Now you oaks are going to 90-year-olds' birthday parties every 2 minutes. I mean, it's so boring. You know, they're just turning 90 all the time. If you go down to Amberglades, there's 4 ladies that are between 102 and 106. Yeah, right here in Howick. Amazing. Longevity is the curse of our time, and it's certainly coming out on all the figures. That's what medical science has done for you, I think. The third one I'm going to jump to is inflation. We really forget how insidious inflation is and what it does. Now, I know every time Michael comes and stands up and does a market presentation and tells you inflation is dropping, I can hear every woman in the room grinding her teeth. Michael, you weren't with me at ShopRite today. Inflation's coming down. You can just imagine. But it is insidious and it eats away at you over time. But the third one, and I put it there in the middle, is the income level relative to the capital that you have. And I'm going to demonstrate to you it is a critical risk in terms of your investments. Doesn't matter what happens from a market perspective. Okay, but first I need to convince you, because I'm about to show you a little bit later that I want to demonstrate numbers in today's value, because inflation confuses us. So if I go back to that person who bought that house for 20,000 Rand, whenever it was, back in the early 70s, late 60s, and said to them, you know, one day this house is going to sell for 2.5 million Rand, they would have gone, don't be silly. Or they would have gone, I don't have to do anything else because I'll be rich. I'll just sell my house and live off those proceeds. But here we are, we've got here, and we suddenly realize, gee, 2.5 million is not really an awful lot of money. And we always have that problem when we look forward, because I can put big numbers in front of you, but you've got no reference point as to what that big number means on a relative basis. So I have to demonstrate to you that I can do things and keep it in today's number for you to understand it. So what I'm going to do is I'm going to start with this illustration. A husband and wife, age 65 and 62. They've got capital of 5 million and an income requirement of 35,000 Rand a month. Now, one of the things we experience the most is that people arrive at our door and they go, Robin, I've got 5 million Rand. And they don't ask, how much can I have? They go, I want 35,000 Rand a month. Not can I do that? Is it possible? What are the implications? Well, that's a starting yield of 8.4% on my capital amount. Now, if we assume that that's just going to escalate with inflation, and I've assumed inflation is 6%, and then I assume an investment return of inflation plus 4%, in other words, 10%, then what does it look like? Well, you'll be very pleased to know, and not disappointed, I've done a spreadsheet. And there's the spreadsheet that really just tracks. Now you can see I've got no market risk, because when you do a spreadsheet like this, you can't really work in the vagaries of the market moving up and down. So you have to pick a number, and it just has to be that steady number. And in this case, it's inflation plus 4%, which is the target return of most of the balanced funds out there. That's what they target their return to be, about inflation plus 4 or 5%. Then you can see what inflation does to your income. So we start at 35,000, but within 10 years, I need 59, almost 60,000 Rand a month to be equal with inflation. That's why I say inflation is insidious, because like that number's scary when you look at it. Then all I'm doing here is I'm taking my opening capital, I'm taking my income off, I'm growing it by my inflation plus 4%, and then I'm getting my closing capital. As you can see, I start off okay, but then it starts to plummet. And by the time 17 years comes, I've run out of money. In fact, I run out somewhere between 16 and 17 years. 81 and 78, with the prospects of 95 facing me. It's gone very quiet in here. So once again, because I know we prefer to look at pictures than numbers, that is my capital charted. Does anyone recognize that shape? Does it remind you of anything? What does it remind you of? Titanic. Well, that wasn't quite what I had in mind. Didn't the Titanic go straight down? To me, when I look at that, it takes me back to my very, very early days in this industry. And that was the plot of a home loan repayment. Does that look like that to you? Remember that? You started, I mean, you must all remember this. You started and you paid and you paid and you paid, and then you got a statement and go, I didn't pay anything yet. For years you paid nothing. And then all of a sudden, it started to accelerate and it paid off. So let's explore that a little bit. Let's go to a home loan for 5 million Rand with a repayment of 35,000 Rand a month, but no increase. And now I'm going to sound like a maths teacher. What you do to one side of the equation, you have to do to the other side of the equation. Remember that? Okay, so if I'm going to have 0% inflation on my income, I also have to have 0 inflation on my return. So I take the return minus 6%, and that gives me 4% above inflation. So my return is 4% plus inflation, and inflation's 0, so it's 4%. That's my interest. How long will it take me to pay off the bond? Hang on. I think we might have found something here. And what I've done is I can use a home loan calculation to illustrate an increasing income and a return as long as I put 0 at both inflation, and I will be able to get the numbers back to today's terms. So I will understand when I see 10 years' time, 15 years' time, the number that the value of my investments will be exactly as I understand it today. Okay, so let's have a look at it with the numbers at inflation. So I'll start with this one. Okay, so there's the home loan. That's what it looks like. Let's move in and take our 5 million rand over there. And what I'm going to do is I'm going to show you at every income draw level. So I'm going to say, if I started at 3% and escalated with inflation, or if I started at 8% and increase it with inflation, what does my capital look like? So in this chart, I'm using a return of 10% and an inflation of 6%. So you can see here, I get this lovely move up and go, jeepers. You know, if I draw 4%, I'm going to be a 30 millionaire. That's a huge amount of money. And you might say to me, well, Robin, look, if I draw at 5%, you know, I'm really only running out of money when 36 years down and 65 plus 36, that's 101. What's the problem? But if I'm drawing at 7 or 8, well, you know what? I'm running out at 17, 18, or 21 years. But, you know, for a long time, I'm still round about the 5 million mark, so I'm okay. But let's use my home loan and take inflation to 0 so we can see the numbers exactly as it is in today's money. That's what it looks like. So the dotted white line is my capital at inflation. Well, inflation's 0, so 5 million is 5 million next year and the year after. And if I draw at 4%, well, then my capital will stay in line with inflation. So I will retain my capital. But look, if I start to draw more aggressively, you can see, well, within 7 years, I'm sitting at round about 3 million. Now, I can tell you this. If you started at 5 million and 7 years in, you're at 3 million, I can tell you, I've been doing this for 30 years, you're at my door panicking, asking me, what are you going to do about it? And this is inflation plus 4%. So I might be in a situation where I've got a lot less risk, but is it doing what I need it to do? And is the problem the market return, or is it the level I'm drawing from my income? And you can see just how quickly that is. Now, I thought about this while I was doing this presentation. I thought, you know, I've been doing this for 30 years, and I was trying to think of how many people I knew actually ran out of money. And I couldn't really get to a lot of numbers on my fingers. Most of them miraculously died before they ran out of money. But as I reflected on that, I suddenly realized that it's probable that the stress of the worry of money is what killed them. When I got to the end of this morning's presentation, I said to the guys, well, maybe you're ready for some tea and snacks. And the guy in the front right here went, no, I need a dop. I said, you'll have to come back this evening. He said, yeah, but then I have to listen to you again. Okay, so, but markets are never linear. So that exercise I've done had the markets, no volatility. So let's have a look at it and see in this period, 2015 to 2024, that 9 years or roughly that decade, it's been one of the worst decades for SA equities. And certainly one of the worst for property. In fact, you know, property was already on its way down in 2018, and then along came COVID and properly killed it. And everyone said the office is dead. Well, I want to tell you, everyone's going back to the office. They're getting back there as fast as they can. So let's consider some real life examples. So what I've done is I've gone into our client base to have a look at this and go, well, what does it look like when I expose someone? Because that's one of the things Harvard House does, is we don't want to eliminate volatility. We want to optimize long-term growth because we believe you need that. It's great to feel good about your investments not being too volatile, but not if it's not doing the right thing for you in the long term. And retirement is a long term. Longevity is that risk. So let's look at some real life examples. So this is, you might recognize these charts. They're extracts out of statements that you get. So you would have seen these charts to some extent. And I know what you're all going to tell me, because you've all gone to the left-hand side and told me, Robin, that guy's got a lot of money. So whatever you say doesn't apply to him because he's got a lot of money. And I don't have that much money. I want to tell you, if you're really bored and you've got some time on your hands, I've got lots of spreadsheets that will demonstrate to you that this principle that I've demonstrated of income relative to growth and capital works no matter how much money you've got. You can have 100 million in overdraw and the same thing happens. You can have 1 million and underdraw and the right things happen. It really doesn't make a difference. So over here, I wish I could tell you that that was the month that Michael really picked the share, put everything in there, and the market just took off. That's not what happened there. He actually put cash in. So that's an injection of capital. But let's have a look at this period, 2015 to 2016. So you'll remember 2015 to 2018, the market was still going well. Property was doing really well. And then we hit 2018 and we sort of started to get onto the slide. It started with Steinhoff, remember that? And then, then it was state capture. And then we had all those guys attacking some of our best companies and shorting them to make big profits. And really that was the slide. And then you can see there's COVID for this portfolio. And here we are sitting at a new high. No new money added into this portfolio. Income at sub 3% on this portfolio. What about where it's invested? Well, the dark blue is equity. The light blue there is property. And if your eyes are really, really good, you can just see this tiny line of bonds, which is white. It's less than 0.79% of this portfolio. There's almost no bonds in this portfolio. And then there's a little bit of cash, which varies depending on whether we're selling and holding some cash for a better opportunity or if the clients asked for cash. But there you can see, exposed completely to the risky asset classes, income draw is in line with under a recommendation, and this portfolio is sitting at a new high, having been through the worst period in the South African markets. Let's have a look at the income generated over that time period. Well, obviously the big jump here was because he added the extra cash. So let's just look from here. So we can see nice upward trajectory, exactly what we're trying to do. Grow income will ultimately grow capital. That's our philosophy. We're doing that. Along came COVID, and certainly dividends did drop, but they didn't disappear entirely. Now, you'll remember at that point, there were a number of companies that withheld their dividend just to protect their balance sheet. The banks weren't allowed to pay dividends in that time. And the property stocks obviously also saw their dividends disappear. But a very strong recovery in the next year. 2022 was exceptional. Now it looks like it's fallen back in 2023, but just to say in 2022, what's included in there is what we call some special dividends. So companies occasionally pay their normal dividend, and then they give a special dividend if they have exceptional cash. And in that case, it was particularly a company that was paying down its capital. It sold the business and it paid that cash back to the investors. And then you might say, whoa, 2024 is looking really bad, Robin. But this is a calendar year. So that's actually only to the end of August. We've still got September, October, November, December's dividends to come in. And we're expecting that the dividends should be actually higher than that block when we bank it. So we're getting this really nice bottom left to top right growth in the income over time. What about his income use? The orange sections in here is the income that he's taken for personal consumption. The blue blocks are what he's given us back to reinvest. And that is the really powerful thing that allows a portfolio to sustain through that period of time. And it's why it's so important that you draw at a level that makes sense. Because when you draw in excess of the income that's created, when it comes to the end of the month and we have to pay you an income, where do you get it from? Well, we have to sell a share. When we sell that share, not only do we lose that share in there, we also lose that share's income. So it means at the end of the next month, when I have to pay the income, I've got even less income to pay, which means I've got to sell more of a share in order to do that. Whereas if you're giving some back, well, there's the opportunity to compound. It also means that when we have the COVIDs and the market goes down, I'm selling a share to pay the income. And when the recovery comes, I still own the same number of shares, so I enjoy the recovery a lot better. Let's go to a smaller portfolio. This demonstrates maybe a little bit more. So this client started with just over R1 million back in 2009 and didn't draw any income for that initial period. And you can see the portfolio grew very, very nicely up to about 4 million, around about 2016, 2017, went sideways for a while. And then this drop here was R1 million. You'll actually see it when I show the breakdown. He took out R1 million and then he put it back in over here, over that time period. So you can almost connect those two and put them there. Then we had COVID, and you can see the drop looks a lot bigger there. And that's because this portfolio had a much higher percentage in property. But here we are sitting at a new all-time high. This client is drawing at under 5% on his income. Where's he invested? Well, there we go. There's the equity. And you can see just how much he had in property leading up to and through the worst part. So that was really where the first cracks in property started to show. Then we had COVID came in. You can see the R1 million cash out and then in. And you can see there's no bonds in there. The bonds is a tiny sliver. Equity and property. Drawing at the right level at a new all-time high. Through the worst period we've seen in living memory. Income, similar picture. Bottom left to top right, we see here in 2020, there's the drop-off. Didn't recover quite as quickly because of the percentage of property. Property took a little bit longer to give your dividends back afterwards, but has recovered quite nicely. And again, don't be fooled by the 2024. We've still got substantial dividends to pay before the end of the year. We expect that that bar chart will come up quite nicely. But look at his income use. Took his income. He obviously didn't use and gave us most of the income back in some of those years, but he's a regular reinvestor of income back into capital because he's drawing less than the portfolio is producing from an income point of view. He's within guideline. And so as a result, he's weathered the worst period we've seen over that time. Let's look at a third example, roughly the same amount of money. When this guy started, he was drawing at 8% on his income. So the big jumps here, this was when he retired. So that was the payout of his Provident Fund and some other investments into that. And so he added to the portfolio, took him just over that point, and he was drawing at 8%. We had conversations with this guy all the way along going, we're really concerned you're drawing too much. And in the period where the market was doing okay, he says, no, but you guys are doing okay. That's no problem. We say, yes, but guaranteed markets don't always go in a straight line. They disappoint us at times. And we can't tell you where it's coming because the crystal ball and the owl, we don't speak owl, and the crystal ball doesn't work because it's powered by Eskom. But anyway, and here you can see the fall off during COVID, which is accentuated by the fact that he's consistently drawing at a higher level. And they just don't have the recovery that you see in those other portfolios. Why? Because we destroyed capital funding his over or excessive draw on income. So by the time the share prices actually started to recover, he didn't have as many of them, which means the portfolio didn't turn around to the same extent. You can see there's that really nice good news. There's the good news. Those people who wanted good news, there's the good news. Is just what we've done and seen since the election has been very kind to us, and the markets have been quite strong. And there has been that tick up, but certainly not at an all-time high like the first two clients because of the level of income that he's drawing. Again, asset classes over time. There's the equity and property. You can see we had to sell down the equity in order to fund income, small amount of bonds, and he has corrected and reduced his income substantially in the last year. I think he finally listened to us and has adjusted from that point of view. And you can see there's been a slight move around. But this movement here, the recovery in the market post-COVID, he hasn't enjoyed because he's destroyed capital in generating that high level of income. It becomes visible in the income side. Initially, you could see the growing income, but actually there's not been that recovery because of the fewer number of shares throwing off less dividend because we've had to sell shares to fund the income. And that is really demonstrated in this chart. He uses all the income and more every single month in order to provide his income. It's a sobering picture. So in conclusion, while volatility cannot be ignored, we would never deny that we will be more volatile than most. It is not the biggest risk that an investor faces, especially an income-dependent one. Now, what very often happens when I do presentations like this is somebody will come to me afterwards and go, Robin, that was all great. Thanks. Nice presentation. But I'm a growth investor, not an income investor. And I want to tell you the most powerful thing in growth investing is compounding your dividends. You actually are an income investor because you want to generate income to buy more capital so that can generate income so that you can buy more. It's still about the same thing. There's no point in getting and becoming the wealthiest guy in the graveyard. Investment is actually about one thing. It's about creating a pool that can produce a passive income stream when you don't want to work anymore. There's actually no other reason to invest, to be honest, other than to maybe make your children rich. I don't think that's the point of life, is it? Anyway, well, I'm certainly not working on that. I hope my children aren't disappointed. Longevity is a secular trend that challenges the idea to be too conservative too early. I didn't have people tell me, Robin, I'm old, you know. Anything could happen next week. I could die. And I rather flippantly go, what's the problem? Because the only time you don't need money is when you're dead. The risk is if you live too long. And if longevity's in there, that's a real challenge. Inflation is a silent menace that stalks every consumer. That's the truth. And by far the biggest risk to most investors' portfolios is the income draw level. A reasonable draw can weather incredibly difficult circumstances. Ladies and gentlemen, that brings me to the end of my presentation. I'd be very happy to answer any questions. There's lots of members of the team here. Thank you very much. Yes, sir. Okay, fantastic question. I promise you, when I answer this question, you're going to think I paid him to ask that question. I promise you I didn't pay him to ask that question. Okay, so this is one of the things. So it's a common question that comes from investors because they say, listen, this thing's doing terribly. Why don't you sell it and move over there? Okay, Now, bear in mind that I haven't realized a loss in your portfolio until I sell it. When I sell it, I've realized that loss. Where I now go with that money, I've got to be very, very certain that I'm going to make the growth up there. And how do I know that I'm not buying some risky asset that is also going to suffer a drop? So what we do before we do that is we look at it and we go, does it make sense to sell this asset, or is it mispriced by the market? Because as soon as I do that, your property portfolio down, let's say 30 or 40 or 50%, I've now got to get 100% to recover your 50%, because the 50% down, it's 100% back up to do that. Now, interestingly enough, if you look at the property sector, if you'd held a lot of those property stocks from the bottom, you've done 100% back up. What everyone was baying for us to do was sell this property and go and put my money in the S&P 500. You wouldn't have done 100% from the bottom. You did better by holding the property and riding the recovery than you would have by selling that and going and buying the S&P 500. And that's before we took into account the revival of the income. Because we knew that the pricing of property was a sentiment thing. You see, let's just say I'm selling this chair, and everybody in this place wants this chair, then I can drive the price of this chair way beyond what it costs to make. But if for one reason, let's just say somebody goes, that chair's got a crack, the first time you sit on it, it's going to fall. Then immediately, everyone who did want that chair no longer wants it. What's my chair worth? Zip. Because if I paid for it, it's only worth what the next guy will pay for it. And everyone's gone, no, thank you. I don't want that. But actually, there's nothing wrong with the chair. But it's going to take time for people to realize that there's nothing wrong with the chair. And that's exactly what happened in the property sector. So when the property sector did what it did, we looked at it and we said, do we want to crystallize this loss? No, it does not make sense. In fact, if you had bought at that point new property at that space, if you bought into those property stocks, you would have handsomely outperformed the S&P 500 over that time period because of the recovery in the property stocks. Now, who would have said that, given what's happened in America over the last little while? But the logic is, you see, as human beings, we go, just do something. And sometimes what you pay us to do is to not harm yourself and to do nothing. I like to use, if you've heard me present enough, you'll know that I've said that portfolio management is like a test cricket innings. It's not that the Sachin Tendulkars can play a shot that nobody else can play. What makes the Sachin Tendulkars and the Jacques Kallises better than everybody else is a shot that isn't very elegant. It's called the leave. Let the ball go. Because the one that can get you out is the one that's going to kill you. That sends you back to the hut. And sometimes in portfolio management, leaving is the right thing to do. Leaving was essentially the right thing to do in property. Why? Because we saw the dividends come back. We've seen the prices come back. And property has enjoyed a rejuvenation. What's happened in terms of the South African property sector is that when load shedding happened, what have they all done? They've all gone put solar on the top of their roofs. And now they've got an extra revenue line, because not only are they charging rental, they're now selling the electricity to their tenants. I had in Joburg on Tuesday, when we were up there, we actually sat with the director of a listed property company. He says, oh, it's so nice. We're making so much money out of our electricity now. We've got electricity back, but they're selling it to their tenants. Why? Because they're selling it less than Eskom, but it's a whole line they didn't have. They're paying off that capital intense. So property is sitting in that space. And everyone's realizing, well, hang on, property is not gone away. So we looked at it at this point and said, to sell this asset at this point is giving it away. We would be doing our investors a disservice. The rentals are going to come back. The value of the property is going to come back. Once sentiment changes, we'll see that. And that's certainly, well, that's happened already. There it is. You can see. Well, look at that. So there's COVID. There's the property recovery. It's steeper than the equity recovery. Property's recovered phenomenally. And we think it's got more room to go. Okay, makes sense. It's very, very normal to feel what you feel. You only get a statement once a month. We have to look at it every day. It feels like we're on the roller coaster. They don't even give us any popcorn to make it feel a little bit better. Thank you. It was a really nice question. But it's a good point because lots of people felt that way. I'm sure you asked that question for a lot of people in the room. His name was Bollinger, actually. Yeah. The Bollinger is named after, I think it was Rudolf Bollinger. I'm not sure of his first name. But he's the guy that kind of used that thing as a track. Listen, the Bollinger bands are used by this thing called technical analysis. So, I mean, if you've ever seen these guys, they draw lines and cups and saucers, and when it breaks through this level, then it's going to go to that level. I mean, there's a whole world of technical analysis where guys buy and sell purely on technical analysis, and it's just charting. It's just drawing lines and charts and candlesticks and the whole thing. So it was a nice illustration because it took that standard deviation and showed that, but it's not something that we particularly look at particularly. To go back to a CAP and an EOH, I think one of the things about asset management that you have to realize is we expect in a portfolio, we're going to have some disappointments. One of the things that is maybe a little bit, that is different to having the kind of portfolios that we do is that you see everything that happens. And it stays there and it's visible to you because every line is disclosed. In a unit trust, I send you a fact sheet. I don't give you the whole breakdown. You'll just see the top 10. And if a share really does very badly, it drops out of the top 10. It can be in the top 10 on end of July, out of the top 10 in August, and you'll pull out the August sheet and go, thank goodness they haven't got it. When in fact, if you pulled out the July sheet, you would have seen it in the top 10. And so, there's a lot of things that happen under the top 10 in a unit trust that is not as visible to the man in the street. We give you that full clarity. So one of the things you have to accept, and it's the same in unit trusts or portfolio, is the reason why we don't buy just one share or two shares or three shares is because we expect over time there's going to be some disappointments. And you cannot spot them coming. And they will be for reasons that you don't know, either because of something that happens overseas or a disappointment about management or an internal management strife or whatever it is. Or, I mean, listeriosis, there we are. That's been through the paper again. Now, that's obviously poor management, which is what is being shown. But actually, that's the kind of thing, like, as investors, you're looking at the balance sheet, the income statement, you're doing all this research in the company. How do I know that they're not looking after that inside? And then it comes out, and that's the reason why you have to diversify. Because you expect that you're going to have some disappointments over time. And I think it's been very, very difficult. So EOH, as a case in point, I mean, they were right in the midst of the state capture. I mean, I think there was the skullduggery that was going on there was probably close to a Steinhoff type thing, really linked with government and government contracts. And it's never really got off the floor again, despite their best efforts. CUP is probably just in an environment where the impact of no GDP growth in South Africa impacts them horrendously. I mean, they're a manufacturing, consumer-facing production company. And, what's happened in South Africa, you're a small cap, they've been hammered. There's lots of small caps that have been hammered out there. Does that answer your question? Do you have them in your portfolio? I think you must talk to your portfolio manager. Yeah, look, I mean, I think, so here's one of the things, here's interesting. Somebody said to me today that they listened to Jeremy Gardner from Investec. Apparently he presented via online at the Ambers today or yesterday. And he was very bullish on South Africa. So I'm sorry to say, I'm glad Investec have caught out to our 12-month view on South Africa. But we've also been very bullish. And we think that, if you can start to see 2 or 3% GDP growth, we were given a lot of stick when we were saying we think load shedding is going to decline and look a lot better. It might not have gone away, but we think there's this reform that's happening that's coming through. Well, we now, what is it, 165 days with no load shedding? Not sure of the exact number, but that makes a massive difference into GDP. We suddenly have a situation where the oil, I think the petrol price is going to come down another 70 or 80 cents shortly. That's a positive. We're going to get some interest rate cuts. And the foreigners are starting to look at our bond market. Willie was telling us that the long end of the curve, which normally is about 3% oversubscribed this last week, was 7 times oversubscribed, people wanting the long end of the bonds. And yet, not that long ago, we were talking about a debt trap for South Africa. There was real concern about government and finances. So if you start to get a GDP growth that exceeds 1%, gets closer to 2%, 3%, those shares are really going to pay off for you in there. And in terms of the balance of your portfolio, what your portfolio manager, I'm not sure who it is, you'll have to talk to them, but I'm assuming that they're making the decision relative to everything else in your portfolio that it's worth hanging on for that recovery. Does that make sense? Cool. Had enough. Need a drink. Sorry. Okay, ladies and gentlemen, thank you very much. If you've got any other questions, you're welcome to come and ask us. Thank you for coming out.